Okay, let's go ahead and move on to my selection for this month. The company is Hawkins, ticker symbol HWKN. It's a little bit off the beaten path. Happens to be a company that was classified in the environmental industry within Manifest, but I've actually changed that. You can see that the track record's fairly got a fairly good and straight trend there with some bumps. I'm actually going to move it over to specialty chemicals because that's what they do. And the image that you see superimposed there is David L. Babson. So this is a David L. Babson Memorial Choice. And one of the reasons I brought up Mr. Babson was, again, he was a frequent contributor to the pages of Better Investing magazine. But one of the things he was known for was the strength of his industry studies. And one of his favorite industries to study was specialty chemicals. And again, it comes all the way back to that recurring theme from Hughes' Big Picture, the Maslow hierarchy of needs, and how, you know, we have certain needs. Hugh keeps referring to fat, but it does revolve around chemicals. And one of the things that Babson would tell us is, you know, watch for opportunities to buy into companies that provide things that we just absolutely need. So specialty chemicals was one of his favorites to watch for. The company does have a 14 to 15% top line growth rate as shown here. It is in a bit of a cyclical industry, so as you can see, here's the management report card, which we know as the profitability trend. The impact of the Great Recession is fairly clear, and they're probably a leading indicator. They're probably early in this regard, but you can see that the number actually did swoop down quite a bit. It has recovered in recent years, and it would be reasonable to expect it to live somewhere in this 8 to 9% range, I believe, over the long term. It certainly wouldn't keep going up into double digits, but again, just recognize the fact that there are some cycles, and that you know, somewhere in that 8-9% range probably does make a whole lot of sense. What do they do? Busy slide, but they're basically in the area of providing chemicals to people who do water treatment, pharmaceuticals, a variety of different construction-related businesses, but basically the whole gamut. They've got they serve a large set of customers. I like the fact that they do have a concentration in water treatment. I think water is a very strategic area for long-term investing, and I'd bet a paycheck that they provide some materials to Eli Lilly down there in Indianapolis. It's a good Hoosier company heading into March Madness, so a lot of this stuff just kind of starts adding up for me. The picture just kind of drives home who they are. You can see the chemical barrels there, a bunch of engineers, scientists, and people generating stuff that people need. And here's our equity analysis guide on the company. Again, as of yesterday, it's a relatively small company. 200. It's not a new company. The company is actually 73 years old. It's still growing at 14%, believe it or not, at least over the last several years. The company has pushing up on $300 million in sales, currently with 10 million shares outstanding, and current price of $38.86 on earnings per share. That is through the March 31st quarter. The PE is somewhere in the range of 15, so 15 times earnings. The three major milestones: sales growth rate in the 14 to 15% range. You can knock it down to 14 if you insist. That means that the company could reasonably be a $500 million company 5 years from now. Again, margins stabilizing in that 8 to 9% range, so we pick for our profitability a net margin in the future of 9%. The shares have been relatively steady, so that could lead to a 5-year EPS forecast of about $4.74. Again, that's a fairly reasonable estimate based on the picture that we see. The PE ratio for this company, it does garner a lot of respect in the industry. Fairly well managed, even though it's kind of off the screen. It's in the extended edition for Value Line, but again, a PE of 16 doesn't seem terribly unreasonable looking at their track record. So we're talking about a company which does pay a dividend. They do have cycles. Their cycles are fairly suppressed, but 3% dividend combines with the annualized price appreciation if it does become a $75 stock of mid-teens. Again, it's a fairly attractive number based on the universe of companies that we look at. And you saw that it was near the top of size screening results as he discussed CSCO. So it's a little bit different. I think that it always helps as you're building out a portfolio to find a few smaller companies with higher growth rates that are a little bit different. So my selection will be Hawkins. Any questions or comments, guys?
Sorry, I went on mute. Looks fine.
Do you have any? Do you have any exposure to these guys in the pharmaceutical world, Hugh?
Hawkins, no. I mean, they supply raw materials into some processes,
Mm-hmm.
but it's actually a very good observation to look at specialty chemicals, because once you get embedded into a product, it's very difficult to get chucked out. As long as you're not selling a commodity chemical of some kind, if it's a specialty chemical, it has to meet certain specifications.
Mm-hmm.
You know, you're there for the long haul. They'll try to beat you up in price, etc. But you're in that product, you know.
Absolutely, and that's a point that David Babson used to like to make also about the nature of being in those type of companies, specialty chemicals. Well, with that, let's just go ahead and have another quick commercial. Again, I wanted to remind everybody that our Groundhog Challenge is in its 5th year, and you can still join, even though we actually got kicked off on Groundhog Day, February 2nd. Again, it's as simple as sending 5 tickers to us, and we take it from there, and we have a lot of fun just kind of kicking that around. So again, anybody and everybody is invited to participate. I don't know if a groundhog struts or not, but something like a good catchphrase, strut like a groundhog.